Hey, what's up, my friend? So I'm ecstatic, right? Because in today's training, you will discover 11 price action trading strategies and techniques that work. And as you can see over here, right, here is a glimpse, right, of what you're about to discover. You'll learn a reversal trading strategy which offer low risk, high reward trading setups, the BWAP trading strategy to ride massive trends, how to enter the breakout before the price makes a big move, and so much more. And here's the thing, right? The examples I share later on are primarily in the Forex markets, but it doesn't mean that it only works in the Forex market. You can apply it to Forex, stocks, futures, etc. You can trade this on the daily time frame, the weekly time frame, the 4-hour time frame. It's up to you. Okay, so these techniques that I'm about to share with you, they are robust. But promise me one thing. Promise me. Whatever I'm about to share with you, don't take it at face value. I want you to do the work to validate whether this works for you or not, because just because something works for me doesn't mean it's going to work for you. So you must do the work. Take the concepts, take the strategies that I'm about to share with you, right? Validate it on your own, right? And see whether you can make it work for yourself. Sounds good? Then let's get started. So the first technique that I want to share with you is called the false break. This is in essence, right, a reversal trading technique, a reversal strategy that allows you to find low risk and high reward trading setups. So here's how it works, right? The first thing you want to look for is a strong momentum move into support. Okay, so this is for a long trade, a strong momentum move into support. Then you want the price to take out the previous lows of support. And within the next 1 to 3 candles, the price rallies strongly and close back above support. So in essence, it looks something like this, okay? Price makes a strong momentum move into this area of support and then quickly reject it up higher and close strongly above support. So vice versa for a short trade, right? You're just looking for a strong momentum into resistance, get a price rejection, and that's pretty much it, right? So let me share with you a few examples, right? So you can see this in action. So first example over here, the S&P 500 on the weekly time frame. You can see what I mean over here. At this point, you can see that we have a strong bearish momentum coming in all the way down into this area of support. It even took out the lows of this support. Now, why are we looking for the price to break below the lows of support? Very simple, right? Because that's when breakout traders will be looking to short this market. If the price, breaks down below support, they think, it's doomsday, let's sell. And they go short, they sell the market. And when they sell, they would have to, put stop loss in place, right, in case the trade goes against them. So for traders who short the breakdown, where will they put their stop loss? So ask yourself, right, look at this chart. If you are shorting this market at this point in time, where will you put your stop loss? If you're like most traders, I'm going to guess that you will put your stop loss maybe above this highs, maybe somewhere here, or the really conservative one even above this highs. Fair enough, right? So here's the thing, right? We are looking, right, to profit from this group of breakout traders if they get it wrong. And how do we know when they're about to get it wrong? That's when we have the false break setup, when the market makes a sudden reversal up and close, right, bullishly above support. So at this candle, you can see that this market made a sudden reversal and close strongly above support. And this is a signal for you to go long, right, and to trade, right, the opposite end of the momentum, opposite of this bearish momentum that occurred previously. Okay, so this is what I mean by a false break setup. Very simple. Strong momentum into support, price took out the previous lows, and then we have a strong bullish reversal closing back above support. Now let's look at the another example, right? How about a short trade? So over here you can see that again, same concept. At this point, this is bullish, right? I mean, if you look at this chart, right, many traders will think, oh man, Rainer, the price is going to the moon, right? Let's buy. And they buy it, right? Price broke out of this highs, above resistance. Look at this, Rainer, it's so bullish. So breakout traders, they go long. Now ask yourself, right, if you are long, if you're buying this breakout, where is a logical place to put your stop loss? Well, most probably for most traders, they might put it below this lows. After all, hey, Rainer, this is so bullish, man. The market is not going down. Don't kid yourself, right? You're such a noob, right? It's going higher. Then they put their stop loss maybe below here. Maybe some put it in the middle of the range. Maybe some even put it below this lows. At this point, right, we are not looking to sell yet because the market has not given us a clue that it's about to reverse lower. We are looking for a false break setup. And at this point, 2 of the criteria are met. A strong bullish momentum and the price taking out the previous highs. The third thing we are looking for is a strong reversal closing back below resistance. And we have it over here. Notice the strong bearish reversal closing, right, even below the opening price of the previous day. Okay, so this is where you're looking to sell, to go against the herd, right, who are looking to buy. So we will talk about stop loss later on, but generally you want to set your stops right a distance away from this highs, maybe somewhere about here, to give it some breathing room just in case the market makes another spike higher and then reverse lower. Okay, so you can see that in this case, your risk, right, can be defined from here all the way to here. Your potential reward, right, from here all the way down to possibly at this area of support. So you can see that from a risk to reward standpoint, this is a pretty favorable trade to take. Okay, so yeah. So no point showing you the end result of this trade because, you know, it's obviously cherry pick, right? Because I'm trying to explain this concept of the false break. So now that you understand what this means, let's move on into technique number 2. The breakout with the build up. So if you actually take the letters, right? B, W, A, B. I call this the BWAP trading strategy. Let's say it together. The BWAP trading strategy. BWAP. Okay, so this is simply, right, a breakout trading strategy which allows you to ride massive trends because you are entering, right, at the nascent stage of a new potential trend. So what you're looking for is, number one, a range market. The market has to be in a range, right? So if you want something more objective, look for a range of, you know, at least 80 candles or more. Then the price, right, consolidates at resistance, otherwise known as a build up. So this is where the price is at resistance and it starts consolidating, right, for like, you know, 10 candles or so, right, forming a very nice tight consolidation. I call this a build up. And then you'll look to buy the breakout of resistance after the build up has been formed. So again, examples, right, to illustrate my point. So if you look at this one over here, dollar against the Chinese yuan, you see over here at this point we have a, number one, the range market. Over here, this is the range market we have. I would say this is there is at least 80 candles or so over here. You can see that this is in a range market. Number 2, we are looking for a build up, and the build up form over here. So let me just get rid of some lines so you can see clearly. Okay, you can see that this build up formed at the highs of this resistance that I've drawn earlier. So this is a sign of strength because it's telling you that even though the price is at resistance right now, there are still buyers coming in right now willing to buy at these higher prices, even though they all know it's at resistance. So there is demand, right, for this particular product, which is dollar right now against the Chinese yuan. There is demand for it, right? Buyers willing to buy at these higher prices. And what you can do is that once you identify a build up at resistance, all you need to do is just to place a buy stop order above the highs of resistance. So in this case, it's above this highs. And you can go long the moment the market breaks out above it. You can wait for a candle to close above it as well if you prefer, that's fine. Okay, so this is what I mean by a breakout with a build up. And you can see that in essence, right, why you can ride massive trends is that because you're about to trade, right, in the direction of a new trend. So in this case, the prevailing trend earlier was in a downtrend. Then the market consolidate. Okay, and if it does break out, right, you are pretty much entering as early as possible, right, in this new existing uptrend. So this is why I say that it allows you to ride, you know, massive trends. And one way to ride trends, you can trail your stops using the 20 MA or the 50 MA. Another example, right? Let's have a look. This one over here, same thing, right? Look at Bitcoin. Isn't the setup similar? I mean, there are variations to it, right? But generally, the idea, the core idea is pretty similar. Number one, again, you see that this market is in a range. When it's in a range, the next thing we are looking for is a build up at resistance. And this is the build up that's being formed. And one little tip that I have for you is that sometimes when the build up is forming, right, you're not sure whether should you be buying right now. So use the 20 period moving average as a guide. Ideally, right, I want the 20 MA to touch the lows of the build up. And as you can see over here, the 20 MA, right, has touched the lows of the build up. Here, it touched the lows over here. This signals to me that this market, hey, now it's ready to break out higher once the 20 MA has caught up with the lows of the build up. Because for that to happen, the build up must form, right, for a certain period of time, you know, maybe 10 candles, 15 candles or so. And again, entry trigger is simple, right? The entry trigger is usually the most simple one. It's the context of the market, right, that you need to spend time recognizing. What you need to do is just simply set a buy stop order above this highs to get long. Okay? And stop loss, you can just simply set it 1 ATR below this lows, maybe somewhere about here. I'll explain why 1 ATR below the lows later on, right? But for now, this is the BWAP trading strategy, right, that I want to share with you. Okay, so moving on, right, now that you understand the breakout with the build up, let's talk about the third technique, the pre-breakout technique. So this is fun because what you have learned earlier, the false break and the build up, right, we're going to combine these two techniques together, and it's what I call the pre-breakout technique. This is an entry technique to let you enter the breakout before the breakout. So how do you actually enter a trade before the big move occurs? Well, you need to use the pre-breakout technique. So very simple. Number one, you look for a build up on the higher time frame. For example, it could be the daily time frame. Number two, you want to go down to a lower time frame and look for a false break setup. This could be, let's say, the 4-hour time frame. Okay, so let me walk you through an example to see this in action. So first one over here, New Zealand against the Canadian. Okay, so let's first and foremost, I said that you want to look for a build up on the higher time frame. So you can see that over here, New Zealand Canadian, we have a build up form over here. So this is the daily time frame. Now we need to go down to a lower time frame to look for a false break setup. So I'm going to do some magic here, right? So let me just split the chart into two. Ka-ching! Okay, so this is New Zealand Canadian daily time frame. I'm going to change this to New Zealand Canadian 4-hour time frame. Okay, so this is the 4-hour time frame. So now let me just orientate you quickly. So you see over here, okay, this is the build up portion. I'm going to click on this and the 4-hour chart will adjust accordingly. This is it, right? Okay, so this over here, you can see the daily time frame, this portion here is equivalent to this portion that you see over here. Okay, so now you understand where you are in the big picture. Daily time frame, it's here. 4-hour time frame, it's here. So what are we looking for? We are looking for, number two, a false break setup on the lower time frame. So look at this 4-hour chart, and do you see a false break setup and resistance? Well, I see a couple, right? Number one is this one, a false break of this highs, and number two, another false break of this highs over here before the real move occurred down lower. So in this instance, right, you may or may not get stopped out on the first try, which is this one over here. But if you attempt another try, right, this would allow you, right, to catch the strong move down lower. And this is what I mean by the pre-breakout technique. Very simple, right? Identify a build up on the higher time frame, and number two, go down to a lower time frame and look for a false break setup. And these are concepts that I just shared with you 10 minutes ago. Can you see how we are building concepts on top of concepts? Okay, so let me give you another example, right? So I know, yeah, right now all this all happened after the fact, right? Blah, 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 easy to watch, right? So let's look at something now that has not happened yet. Okay, so New Zealand yen. So what I'm seeing right now is that on New Zealand yen, the weekly time frame, I'm seeing a potential build up that's being formed over here. Can you see it? I'm sure you can, right? So now, what's the next step? Well, we want to go down into a lower time frame and look for a false break setup. So since this is the weekly time frame, the daily time frame can be our lower time frame. You generally want to go down between a factor of 4 to 6. So just very quick illustration, right? So a weekly time frame, okay? Weekly time frame, right? You know that there are 5 days in a week. So that is a factor of 5. What if a daily time frame? You know a daily time frame has 24 hours. Okay, so with 24 hours, you go down to a 4-hour time frame. That is a factor of 6. So why 6? Because you take 4 multiplied by 6 over here, give you 24 hours, which is 1 day. Okay, and for the weekly one, let's say 1 week, you have 5 days. So that is a factor of 5. So simple stuff. Okay, so anyway, now that we go down to a lower time frame, the daily, we are looking for a false break setup. And on here, what's interesting is that the highs and lows of the build up that you have seen earlier is likely to be support resistance or swing high, swing lows on the lower time frame. So as you see over here, right, this is now an area of resistance and this is possibly an area of support. So since the trend is lower, I want to be selling in this market. So what I'll do is I'll wait for the price to come up into the highs of this resistance, give me a nice false break setup and close lower, and I'll be looking to sell this market. I'm selling at the highs of resistance. I'm selling when the higher time frame is in a downtrend, and this is the type of trade that I love to take, right? This type of trade offers you favorable risk to reward, because if you think about this, if the market could break down below these lows and the downtrend continue, what is the potential risk to reward on the trade? You could make $1 to make $3, maybe even $1 to make $5, depending on how you manage the trade if it moves in your favor, right? So this is powerful stuff, right? So don't underestimate the pre-breakout technique. And I'm not doing anything fanciful over here. All I just did is to combine concepts that you have learned earlier. That's it. Okay, moving on. Number 4, the break of structure technique. So this is an entry technique, right, which gets you into a new trend early, right? So what you want to do is to wait for the price to approach an area of value on the higher time frame. An area of value could be things like support resistance, trend line, trend channel, moving average. These are all areas of value on your charts. And then you want to look for a break of price structure on the lower time frame. Again, these are just the theory part. So let's look at the charts, right, to better understand how all this theory works. Dollar against the Norwegian kroner. Okay, so over here, you can see over here, right? Let me just go up to the weekly time frame. you can see over here that we have a, I think the daily time frame would be pretty sweet as well, right? You can see it. So on the daily time frame, you can see over here, okay, that the price has come into this area of value. This is previous resistance, resistance, resistance that could now act as support. Okay, and here's the thing, right? At this point, right, what if you don't get, let's say, a false break setup, right? You don't have a strong bullish price rejection to show you that the buyers are in control. What now? So this is where you can go down to a lower time frame and look for a break of structure. So I'm going down to a lower time frame, let's say now to the 8-hour time frame, and have a look for a break of structure. So at this point, you can see that at this level, this black line over here is the same level that we have seen earlier. Let me just split up the chart so you can see what I mean, right? And see what I see. Okay, so let me just split the chart into two. Ka-ching! Okay, so this is the daily time frame. This over here is the dollar Norwegian chrono on the 4-hour time frame. I'm going to change this to 8. So you can see that on the 8-hour time frame, you're looking at this. At this point on the daily time frame, price came into this area of support, right? Previous resistance turned support. And on the 8-hour time frame, you can see a break of structure because at this point the price made a higher high, reverse down lower, and then break out higher. So at this point, when the price break above this highs, you now have a higher high and a higher low. So this is clearly is a change in market structure because the previous market structure, if you see, right, it was actually making a series of lower highs and lower lows, right? You can see lower highs and lower lows. So at this point, right, when the price breaks above this highs, this is the first touch point, right, where you made a higher high and higher low, and this is the break of structure. It has broken, right, the prevailing previous market structure. And on top of it, right, we are trading this, right, leaning against an area of value. We are leaning against this area of value on a higher time frame. So we're not just blindly trading a break of structure. We are leaning against the area of value on a higher time frame. And this is how, you want to trade the break of structure technique, to lean against the higher time frame first and foremost, and then you look for a break of structure on the lower time frame. Make sense? Great. So let's look at another example. How about something familiar, the ES? Okay, so the ES again, same thing. Earlier you saw that there was a false break setup on the ES time frame, the weekly time frame, a false break at weekly time frame. If you go down to the 8-hour time frame, you can see that over here we have another break of structure. Over here, series of lower highs, lower highs, lower highs, lower highs. At this point, you have a higher low, and when the price break out of this high, you have a higher high and higher low. And this has broken this prevailing price structure when you form a new higher high and higher low. So this is another break of structure on the S&P 500. And again, we're not just blindly trading this break of structure, because if you see earlier, right, this is actually a key area of support on the higher time frame. If you look at the weekly, you see that this is actually an area of support on the weekly time frame. Make sense? Okay, so this is how the break of structure technique works. So moving on, what's the next technique? The retest technique, right? The retest technique. So this is an entry technique, right, which allows you to catch the trend even if you miss the first move, even if you miss the first wave. I get it, right? Oftentimes I miss trading opportunities in the market. Okay, so what now? Well, first and foremost, the first thing you want to do is don't chase the markets. That is the worst thing you can do, right? Chasing the markets. Because if you do that, chances are you will get stopped out on the pullback or even the reversal. So first tip, don't chase the market. Second thing you want to do is wait for a pullback towards previous resistance turn support. Or if you're trading on a short side, you're waiting for a pullback towards previous support turn resistance. Either or. Third thing what you want to do is to look for a bullish price rejection at support. So let's have a look at an example. So if you look at Aussie yen, okay, daily time frame, okay, I think you can even see this on the 8-hour time frame. Oh, sorry, I think it's the Aussie dollar. Yeah, Aussie dollar. If you look at Aussie dollar, okay, over here at this point, you see a retest over here, right? The price break below this area of support, and then we have a retest over here. So of course, on this time frame, right, there wasn't any entry trigger to go short because on this same candle, right, the price pretty much spike up and spike down. But if you go down to a lower time frame, right, there could be possible trading opportunities which you can see over here. Again, this is what I mean. Okay, so this is the same price level you saw earlier. This is the area of support on the daily time frame. And we're looking for a retest because at this point, right, let's face it, market has head down lower. And I know it can be tempting to chase this market down lower. Oh, Rainer, this market is in a downtrend. It's time to sell, Rainer. What are you waiting for? Christmas? So this is the mindset that, many traders would have, right? You just want to sell right now because the market is bearish. You don't want to miss the move, right? You want to make the kaching, the profits right now. But the problem is that, when you are chasing the market, right, this is where it's prone to make a reversal, a pullback. And when that happens, you'll likely get stopped out. So my first thing I say, right, don't chase the market. Let the market come to you. But where, Rainer, where could the market come to, right? This is where you use the technique I just shared, right? Previous support that could act as resistance. This is what we call the retest. So the price retested this level that we have seen, where we have marked out ahead of time. Okay? And at this point, now, you have a much more favorable trade location to trade from, right? The price show you a bearish price rejection at the retest level that you're looking at. At this point, if you sell over here, your stop loss could just go above this price structure. It could go above here. So at this point, you can see that your stop loss is in a quote-unquote safe location, because for the price to reach this level, it has to go against an obstacle, a barrier, right? This barrier is in the form of a previous support that could act as resistance. So the price would have difficulty going through. Not that it can't, but you have to make it work hard to get your stop loss. See the difference? And in terms of target, you can see that there's a good chance it could swing down back lower into this swing low, and you would, again, right, have a decent risk to reward on the trade. So this is what we mean by the retest. Another example, right, Euro against the New Zealand, same thing. The price has retested this area of resistance, previous resistance that could act as support. So what you don't want to do is that when the price breaks out, when it's so bullish, right, you don't want to be chasing the market at this point in time. Again, no logical place to set your stop loss, right? So let the price come to you. And the area of value that you could have highlighted is this, one of them is this previous resistance that could act as support. Okay? And again, on this time frame, might not be visible, but if you go down to the 8-hour time frame, you realize that there is opportunity to get on board the trade in the form of a false break setup. So what exactly is the false break setup? So that's the first technique I just shared with you earlier. So I hope you didn't forget that, right? So let me just do a quick recap. Number one, we are looking for a strong bearish momentum into support. Number two, we want the price to take out the lows of support, which is this. Number three, within the next 1 to 3 candles, we want the price to rally strongly above support. So in this case, it took 2 candles, right? 1 and 2 to rally back above support, right? Closing back above the above support, right? So this is an entry trigger where you can use to get long. And again, we are dealing with multiple concepts over here. Number one is the false break. Number two, right, we are dealing with the retest of a key price structure, which is in this case, right, previous resistance that could act as support. Okay, so this is, how it works. This is the retest. Number 6, the first pullback. Alright, so this is an entry technique which allows you to catch the trend even if it doesn't make a retest. Because I know many of you who knows basic technical analysis, right? One of the problem you'll face is that, hey, Rainer, don't try to smug me, man. Quite often the price doesn't make a retest. Yeah, I know. I admit, the price may not make a retest all the time. So this is where this 6th technique called the first pullback comes into play. Right? So again, don't chase the markets, right? So if you see me repeating a point multiple times, right, this is where you get a pen and paper and scribble or even write on your forehead, right? It's important. You don't want to, flout these rules. Okay, don't chase the markets. Number 2, wait for a pullback. Okay, this time around the pullback may not come to the retest level you're looking at. So it's fine, right? You want to look for a pullback, and the key thing about this pullback is number 1, the range of the candles, right, has to be relatively small. You don't want a pullback to have, huge, massive candles, because this tells you that it could be a reversal instead of a pullback. And number 2, right, you want the price, or rather, you want the 20 period moving average to catch up with the price, to touch the lows of the pullback. And then number 3, you can look to buy the breakout of the swing high. So again, examples would be good. At this point, right, this is the area of resistance. You can see that when the price broke out, again, many traders would be waiting at this point, which I just taught you earlier, the retest. And that's fine. That's perfectly fine, right? A retest of previous resistance turn support. But I'm sure you can agree with me that the price may not do this, right? So what now? So this is where I said that, you want to wait for the market to do a pullback, right? Let it retest the 20 MA. So if you just pull out your 20 MA, the 20 MA is still pretty far away from price. I can just zoom in, you can see how far the 20 MA is from the price right now. So give it some time. Let the 20 MA catch up with price. And for that to happen, the market has to make a pullback. Usually a wick pullback with small range candles. So you can see the market starts to make a pullback over here. And there you have it. At this point, great. The market has now made a pullback. Okay, this down, up, down. And the 20 MA now has touched the lows of the pullback. So what now? So at this point now, it's different, right? Because now if you were to buy the breakout, let's say the breakout of these highs, you have a logical place to set your stop loss. Where is that? Well, you could set it now below the 20 MA or below this swing low over here. Because if you think about this, right, previously, right, before the 20 MA has caught up with price, previously, let's say somewhere about here, you don't really have a logical place to set your stop loss besides this previous resistance that could act as support. And you can see that your stop loss is pretty darn wide because your reference point is so far away. But when you are patient, when you let the price come to you, when you let the 20 MA catch up with the price, now you have a logical place to set your stop loss. Now you can actually, manage your risk. Okay, so in this case, when the price breaks above these highs, you can now set your stop loss. A few options, right? The 20 MA, which is here, just below this most recent swing low, or even here, right, a distance away from this swing low. So you have 2 points to reference. Number one, from this swing low, or from this swing low over here. And you can use a 1 ATR below it as a buffer. Does it make sense? And this is what I mean by the first pullback. Just because you miss a move, just because the market doesn't make a retest, doesn't mean that it's over. There are still tricks that you can use, right, to catch a piece of the move. In this case, right, you could have, caught the next wave of this market. Okay, so for number 7, before we get started, right, if you are enjoying this training so far, smash the thumbs up button. If you don't, then hit the subscribe button. Sounds good? Then let's continue. For number 7, right, it is don't trade far away from an area of value, right? So why is this, right? Because this helps you to avoid low probability trading setups, right? For example, if the price is overstretched away from the area of value, let's say like a moving average, right? Then you want to skip the trade because more often than not, the market is about to stage a pullback. So let me give you an example. So if you look at this chart over here, this is the dollar against, this is the China A50 market. And you can see that clearly this market is in an uptrend, right? It is above the 50-day moving average and it bounced off it, right? Pretty much a number of times, right? Once, twice, thrice over here. And if you look at this chart, right, as the price approached the $15,000 price point, by now, you should know that you shouldn't be buying at this point because this is where the market is overstretched. This is where it could make a pullback. And this is where the price is far away from the area of value. Where is the area of value? If you look at this chart, I would say the 50 MA serves as a good area of value somewhere here. So this means that the price could possibly retrace back towards this area of value and then continue higher. So if you want to be buying at this point right now, if you were to be buying at this highs over here, then there's really no good level to set your stop loss, because if you set your stop loss here, here, or here, it doesn't make sense because the market could just as well swing down lower, make a pullback towards the area of value, and then continue higher. And if your stop loss is between, this area, you're gonna get stopped out. All right, so avoid trading, right, when the price is far away from an area of value. Trade near the area of value, because when you trade near the area of value, your stop loss, right, can be much tighter. Okay, so next one, euro dollar. If you look at this as well, another way to define your area of value can be trend lines or trend channel, and it's the same concept over here at euro dollar. So you can see that over here at this point, you don't want to be selling at the lows of this trend channel. Right, let me just show you how I draw this quickly, right? So you can see it's just very simple to draw. Connect the line, right, that connect the highs and the lows, right? Get the most number of touches, right? So you can see that the way I draw it, right, I try to get the most number of touches here. 1, 2, 3, 4, 5, 6. Same for the lows, right? So just a parallel line. So again, you don't want to be, trading far an area of value. So in this case, if the market is in a downtrend, you don't want to be selling near the lows of this trend channel, which is here. Okay, because this is clearly not an area of value for short traders. The area of value should be the highs of this downward trend channel. That's the area of value. Okay, so in this case, you can see that the market pretty much, would have, stopped you out of the trade as you retrace back towards the highs of this area of value. Okay, and again, same thing, right? If you were to be selling right near, or rather when the price is overstretched from this area of value, away from this area of value, then you will get stopped out repeatedly. So very simple, right? Whenever you look at a trending market, ask yourself, right, where is the area of value? Which moving average does this market respects? If it's very far away from that moving average, if it's very far away from the trend channel or trend line, it's better not to trade in the direction of that trend at that point in time, right? Wait for the pullback to come, right? It's a much better play. Okay, so number 8. Don't set your stop loss, right, just below support. Don't set your stop loss, right, just above resistance. This helps you to avoid stop hunting. Okay, instead, you want to set your stop loss a distance, right, away from this key price structure. And again, example will help. If you look at this, dollar against the Mexican. Okay, you can see that at this point, right, the market is, I know, in an uptrend. And then some traders might look at this. Oh, Rainer, there's a doji pattern over here. This is an indecision in the markets. Okay, market is about to reverse lower. Buyers and sellers are in control, right? The price cannot go any higher. It's too high. It's about to reverse lower. So they short the market. And where do they set their stop loss? Hey, Rainer, most textbooks says, Rainer, that you should set your stop loss above the highs, above resistance. So let me set my stop loss above these highs. And that's what they do, right? When you set your stop loss above these highs, it is a very prime candidate for stop hunting because this is where everyone else set their stop loss. It's very easy for the price to reach those levels and then reject from those levels after you have been stopped out of your trade. So in this case, you can see that price spike up higher. Okay, it spiked up higher, taking out the highs over here. Those traders who set their stop loss above these highs, guess what? They're stopped out. And then before it continues to, reverse down lower. So again, don't set your stop loss above the highs or just below the lows. One more example, right? This is the 5-year US T-note futures. Same thing. Traders, they will look at this chart and say, oh, Rainer, man, this is bullish, man, Rainer. Look at the price is about to reverse higher. Look at this huge bullish candle, right? I'm trading in an uptrend, okay? Price is near the swing low, near this area of support. I know. Let me set my stop loss below this area of support. And then what happens? Market hits down lower, stop them out, right? The price over here took out the lows of this support before it rallies higher. And there you have it. Okay, so what should you do, right? How do you avoid this type of stop hunting scenario? Very simple. Give your trade, right, more room to breathe, right? Set your stops away from this key prominent price structure. So let me give you a very simple example. Let's say Euro New Zealand. Okay, let's say the 8-hour time frame. Okay, you went long over here. And by now, you should know that your stop loss, right, shouldn't just go smack below this low because there's a possibility, right, the price could make a triple bottom, right, taking out the lows before it reverses up higher again. So what you want to do is just go down to your indicator tab, look for the average true range indicator, pull it out. I usually go with a 20 period. This is just my preference, and I go with SMA. In the grand scheme of things, doesn't make much of a difference, but that's just me. So the ATR value right now, it's about 110 pips. How do I know that? Because that's what this indicator says right now. It's 0.010. So that's about, 0.0110. So that's about 110 pips. So what you want to do is to find out what is the lows over here. As you can see, I've marked out the lows of this candle. It's about 1.7608. So you just take 1.7608. You minus off 110 pips, and that will give you about 7498. So your stop loss, right, will be about 1.7498. Okay, does it make sense? So that is 1.7498. So it's just about somewhere, I think, about here, right? So from this point to this point over here, that is 1 ATR below the low. So that's how you want to set your stop loss to avoid, getting stop hunted. Okay, number 9, avoid shorting higher lows into resistance. So I know many traders, they look at the chart. Oh, Rainer, the price is at resistance, man, it's time to sell. Oh, Rainer, the price is at support. It's at support, it's time to buy. Not quite, because you want to see how the price approach the level. You want to see how the price approach support, how it approach resistance, right? That gives you a big clue, right, to whether that level will hold or break. So Again, an example, right? Let me just get rid of the ATR for now. If you look at Bitcoin, okay, Bitcoin, where are you, my dear? Bitcoin. Do you see it here? Well, doesn't seem like it. Oh, here. Okay, if you look at Bitcoin, I just pull out the chart you see over here. At this point, okay, let's talk about, okay, earlier you saw this one over here, the series of higher lows, or rather the breakout with the build up. Okay, so I go to the daily time frame. Do you see how this market, the way it approaches resistance, is not a nice strong momentum move into it. It's not a nice strong power move into it. Rather, there is a stair-stepping price action into it, like a staircase climbing up into resistance. You have a series of higher lows into resistance. So this is a sign of strength. And that's why earlier, previously, we talked about the breakout with the build up. We are looking for this type of price action to trade the breakout, not the reversal. Okay, so in this case, you don't want to be selling at resistance. You want to avoid selling at resistance because this is a sign of strength. You have a series of higher lows into resistance. This is a sign of strength. And likewise, when you see a series of lower highs into support, this is a sign of weakness. Don't want to be buying support at this point in time, right? I repeat, you don't want to be buying support at this time, right? Because this tells you that the selling pressure, right, is stepping in, right? They're coming in, right, and put selling pressure in this market, right? If you look at just the basic price action, if you look at the range of the candles, right? First time, support. Oh, no, this is not the first time, but previously very strong rebound. Then this is another rebound. Then you got weaker, and then you get even weaker right now. This tells you that the buying pressure, right, are being contained by the sellers. This is a sign of weakness, and this market, right, is likely to break down lower. Okay? So avoid shorting higher lows into resistance, and likewise avoid buying, right, when you see lower highs into support. Number 10, volatility contraction leads to expansion. So here's the thing, right? The market, it moves in cycle. It goes in uptrend, downtrend range. And same for volatility, right? Volatility goes up, then it contracts, and then it goes up again. So as a trader, right, if you're looking for favorable risk to reward trade, if you're looking to, risk $1 to make $3, $1 to make $5, then you must be looking to enter your trades during low volatility period, because that's where your stop loss is tighter, okay? And if the market expands in your favor, if the volatility expands in your favor, this is where you can reap, right, favorable risk to reward on your trade. And that's what the pre-breakout technique is all about. You're entering your trade earlier. When we talk about the pre-breakout technique, is when volatility of the market is low. And when volatility expands in your favor, that's how you reap, right, favorable risk to reward on your trade. You might even forget about that already. So let's do a quick recap, right, to this concept using the pre-breakout technique we spoke about earlier. So earlier we talked about the New Zealand Canadian, and I mentioned that over here we have this build up being formed. So this is in a low volatility environment, okay? And then we got an entry trigger on the lower time frame using the pre-breakout technique. So let me split the chart into two. Ka-ching! Okay, so this is the New Zealand Canadian. This is, let's say, the 4-hour time frame. If you look at the daily time frame, right, and then this is the 4-hour time frame, side by side. Now, over here is in a period of low volatility, right? Market isn't really moving much. Volatility is relatively low. And over here is where we got our entry technique, right? Notice the false break setup that we mentioned earlier, right? This was the false break setup that we had, possibly over here and over here. And when you go short, right, what happens? If volatility does expand in your favor, in this case, you see over here, right, this way, volatility expands in your favor, right? Heads down lower, retrace lower, offers you favorable risk to reward on your trade. I can't see how much money you make on this particular trade. Maybe even nothing, right? If you didn't have proper trade management, the price retrace up higher and you get stopped out, that's possible. But the concept that I'm trying to bring across here is that for favorable risk to reward trades, risking $1 to make $5, you want to be looking, right, to enter in a low volatility market environment, right? Another example, let's say we look at, again, Bitcoin. If you look at the price, right, action before it broke out, right, it's again volatility of the market. Over here you can see that it's decreasing, right, very quiet before it broke down. Okay, same thing over here. If you look back, before this huge move up higher, let me just get rid of this line. Before this huge move up higher, what happens? Volatility of the market is quiet. right? And this phenomenon can be seen in the stock market as well. Go look through your stock charts, right? Before the market staged an explosive breakout trade, what was it like previously? Chances are, volatility, right, is very quiet. Volatility is low. Okay, so this is a important concept, right? Volatility of the market, it moves in cycle. And just one more example to share with you. Dollar against the Chinese yuan, right? We talked about that earlier when we spoke about the breakout with the build up. Look at this market. Before it broke out over here, volatility of the market, right? It is quiet, right? Here is quiet, right? So you can think of volatility in the market as, storing energy, right? Volatility is low, the market is storing potential energy, waiting to make a big move, right? When the market breaks out, right, this is where energy is expended. And then when it gets quiet again, this is where the market is storing energy. And it breaks out, energy is expended again. Okay, so this is a important concept, right? Volatility contraction leads to expansion, right? And ideally, you want to be entering trades during low volatility period. You have a tighter stop loss, which offers you a much more favorable risk to reward. And finally, I want to talk about this, the ultimate price action combo. So what I mean by this is that as a price action trader, as a professional price action trader, you cannot just be a one-trick pony. Like for example, I just shared with you 10 different trading strategies and techniques to trade. And I hope by now you don't just, wait at support. Oh, Rainer, I'm waiting for support, waiting for a hammer to go long. Don't be that one-trick pony, because the market has its way, right, of fooling many traders out there. It has its way, right, of, making many traders miss the move. So you got to approach price action trading, right, using multiple plans of attack. Alright, if this doesn't happen, I have this plan B. If plan B doesn't happen, I have plan C. So let me give you one final example, right, to kind of sum up, right, what price action trading is all about. And I call this the ultimate price action combo. If you can embrace this concept that I'm about to share with you, right, you are going to be an ultimate price action trader. Sounds good? Okay, so to kick things off, right, last example is dollar against the African rand. I mean, we can use this or dollar. I think we can even use a dollar Mexican if you want to. I think, yep. Okay, so let's look at dollar Mexican. So at this point, okay, we can see that this market is in an uptrend, right? And it's consolidating between these highs and these lows. So now, to a very newbie price action trader, what will they do? I can tell you what they'll do, right? They'll say, oh, Rainer, man, the market is in an uptrend. So here's what I'll do. I'll wait for the price to break out, retest this level, form a hammer, and then I go long. And that's not a bad plan, right? That's fine. But let me ask you, what are the odds of that happening? Sure, it could happen. But that's only one plan of attack. If you are a astute price action trader, you're a professional price action trader, let me share with you a multiple plan of attacks, right, that you can come up with. First and foremost, number one, you can look to trade a breakout with a build up. So we spoke about that concept earlier. So number one, we can look at this, prices at this highs. Price could possibly come up higher and consolidate at these highs. And if you pull out your 20 MA, we want to see, support the lows of this build up. And if the price could break above these highs or above these highs over here, whichever you want to use as your reference point, you can look to get long. And again, stop loss can just be 1 ATR below this swing low. So that's the first type of attack. Second one, we could go with the retest technique that many traders are familiar with. This is the area of resistance. Let's say the price breaks out without a build up. We can wait for a retest, form a price rejection at this area, and to get long at this point. Second plan of attack. Third plan of attack. How about this? Okay, let's say, what if the price breaks out, okay, but it doesn't form a retest? Well, what we can do is we can look for the first pullback technique, right? We can look for like a bull flag pattern, something like this, right? A very nice tight retracement, small range candle, and then look to buy the breakout of these highs. Again, your stop loss can be 1 ATR below these lows, maybe somewhere here. That is the third plan of attack. Fourth plan of attack, right? What about this? What if the price doesn't form a nice tight flag pattern? What if the price breaks out and it forms a new range like this? At this point, right, it can be difficult to buy near these swing lows over here. So you can go down to the 8-hour time frame or even a 4-hour time frame to look for a false break setup on that time frame. That's the fourth plan of attack. Can you see how a professional price action trader would think? They don't just have one trick up their sleeves. They can envision potential scenarios, right, that the market could unleash, right, and trade it accordingly. Okay, so this is what I mean by the ultimate price action combo, right? You have multiple plans of attack. And that's just not just trading in one direction. If you want to, you can even trade the reversal down towards the downside using the same concepts, right? A retest, could look to trade the first pullback, could look to trade the breakout with a build up. Can you see where I'm coming from? And hopefully, right, by the end of this training video, I have given you an idea, right, of how price action trading can be like. Okay? So with that said, let's do a quick recap, right? Just a quick one. Okay, so what we have covered today. Number one, the false break setup to trade reversals, right? Offer you a low risk and a high reward trading setups. Then we talk about the block trading strategy, basically buying breakouts with a build up. Number three, we combine the first two concepts into the pre-breakout technique. How do you actually enter a breakout before the market breaks out? Number four, we spoke about a break of structure technique, right? Going down to a lower time frame, right? To time your entries, especially if the higher time frame doesn't give you any signal, right? To get long. Number five, we talk about the retest technique, right? To retest previous resistance that could become support. To retest previous support that could become resistance. To help you time your entry. Then we talk about the first pullback. What if the market doesn't retest the level or area you're looking at? You can look for the first pullback. Then next, moving on, we talk about when to stay out of the trade, right? You don't want to be trading, right, when the price is far away from the area of value, because that's where it's about to, snap back, right? So wait for the snapback to occur, then get on board the trade. Number 8, don't want to set your stop loss just below support, right? Because it's prone to stop hunting. Number 9, you want to avoid shorting higher lows into resistance or buying, right, when you have a series of lower highs into support, because that's where, these areas, these levels is likely to break. Number 10, volatility contraction, right, leads to expansion. Right, you can see that I have difficulty pronouncing the word volatility, right? Contraction leads to expansion, right? And when you want to find favorable risk to reward trade, it's during low volatility market conditions. And finally, we spoke about the ultimate price action combo, how to have multiple plan of attacks and don't just, be a one-trick pony. Okay? So with that said, right, I've come to the end of this training video. If you've enjoyed it, right, smash the thumbs up button. And if you want to learn more about price action trading, what you can do is go down to my website over here, tradingwithrainer.com. I've got a few guides for you, right? The ultimate guide to price action trading, which is this one over here, where you can learn more about price action trading. Or if you want to learn more about candlestick patterns, shooting star hammer and how to trade this type of patterns, then the monster guide to candlestick patterns would be for you. These two are absolutely free. Just click this orange button and I'll send it to your email for free. So with that said, right, I wish you good luck and good trading. It's been a pleasure, right, doing this video for you, and I will talk to you soon.